Okay, it's live at 5 on the East Coast. Dan Weisskopf here coming in. It's looking forward to this nice hot day. I'm going to start letting people in. Welcome to the ETF Think Tank, and I'm thrilled to have Michael Watson as our guest today. And we don't know where we're going to take this, to be perfectly honest. So it's definitely going to be really impromptu. So thank you everybody for joining. And here we go. By the way, I'm Dan Weisskopf, in case anybody doesn't know, otherwise known as the ETF professor and lead ETF strategist for the ETF Think Tank, as well as co-portfolio manager of the blockchain ETF. With that, I am going to hand it off to Cynthia to introduce herself, and then maybe let's go to Dave Abner after that.
Hey everybody, welcome to the show. Cynthia Murphy, head of research for the ETF Think Tank. We're excited for the show today. Have phenomenal guests. I'll let David go first, and then we can go to our guests. David, you're up.
How's it going, everyone? David Chikansky here, fellow portfolio manager in the Title Financial Group. So we have two amazing guests for today's show, David Abner of Abner Capital, abnercapital.com, and a good friend, Michael Watson, formerly with Citadel, has his own consulting business in the alternative cyber. Well, you know what? Actually, I'm going to just let you describe what Hedgineer is, Michael Watson, because it's pretty unique and complex, and I think you'll bring a lot of value to the audience today. So why don't you kick it off first, and then we'll kick it off to David Abner to introduce himself.
Totally. Thanks, David. So yeah, I'm founder of Hedgineer, and it is essentially three different products. Like to begin with, we're Hedgineer, so we're engineers that are passionate about hedge funds. I was at Citadel for the last 8 years, was head of all of the proprietary software that we would build for the Ashler Capital, Global Equity Surveyor Capital franchises that are the long, short, fundamental pod shops. That is 80 engineers globally, from how we think about research, pour through transcripts, construct portfolios that are factor hedged, beta neutral, and then also taking alternative data like geolocation, satellite images, credit card transaction data, lots of web scrapes, and be able to turn that into signals that a discretionary manager can then monetize. A little bit of ran Citadel Securities and Citadel hedge funds shared infrastructure around their shared security master, entity master, and pricing master, some of the back office stuff. Ran the engineering teams out of Asia Pacific for the hedge fund for a while across all the strategies, but longtime Python, C++ developers. So it's a world that I live and breathe in terms of how technology and data is used within asset management. And Hedgineer is meant to capture that. So one, we have a product that we're building on top of really common OMS, PMS tools that have large market share for asset managers. They get software as a service analytics on historical performance with risk models and good analytics around hitting, sizing, what are you good at, what aren't you good at, that oftentimes kind of lives in a couple of these big funds, but most of your other smaller funds don't have the engineering resources to be able to build out really good portfolio analytics tools. And we think we can kind of build that as just a service on top of order management systems and position management systems that already exist. We also do consulting for asset managers who are trying to build up their technology organizations. And lastly, it's just a passion project, but I run the Hedgineer podcast, where we talk about technology, software, and engineering behind prop trading, hedge funds, asset managers, and bring on former coworkers on just to talk about some stuff we've built. So that's just where the product is, the passion, and talk about it every couple of weeks and throw them up on Spotify, Apple Podcasts, YouTube, a lot of stuff on LinkedIn, to be honest. But yeah, that's a little bit of me and what we do.
And last and certainly not least, we have David Abner, an esteemed writer in the ETF space and a lifelong friend of all of us here at Title. Dave, want to jump in and introduce yourself? You've been on the show before, everyone knows you, but feel free to jump in and introduce yourself again.
Sure, thanks. I'm happy to be back on the Think Tank. I love it here. Thanks for having me again. I am currently running a firm called Abner Capital. I'm an advisor across the ETF and the crypto space. And it's quite a moment because those spaces are really coming together in the news every day. So I'm sure we're going to talk about that and later in the podcast. I started out as a proprietary trader making markets in ETFs and closed-end funds many years ago. And I have sort of ridden the wave of developing ETF companies, which we're doing now, running sort of a lot of M&A and corporate strategy through the industry as it grew. And then I evolved and sort of merged that into the crypto space as the two became intertwined. And they're going to continue to become intertwined, I think, as we look at the next 5 or 10 years. So I'm happy to talk about it.
Wait, are we no longer referring to that as your midlife crisis years or what, Abner?
I'm back. I think they're going to continue. It's still a midlife crisis, but it will be for a while.
So first question for Michael. Can you tell us some of the data sets or just like what are the types of approaches hedge funds are really striving to take to get like the most unique data sets in today's markets? Like how much money are people spending? Where are they trying to go to? Obviously, you can't give us like insider secrets, but how far into the weeds is this going? You know, we all heard news stories of satellites counting cars in Target parking lots, you know, like 8 years ago. And that kind of probably feels like light years in the hedge fund alt data space. Like what are some of the new things that, you know, people are tracking that we might not even be considering?
I mean, a lot of it is actually stuff that is getting more nuanced for data that's already been around. So like the biggest data sets that were being used were transactional data sets for a long time. Like you go swipe a credit card, like this is just generally, this is nothing like specific, but you swipe a credit card and then that creates a data footprint. It has a description and a total amount that you spent. And then you could use that to be able to forecast like same store sales, total number of new customers. And there's a lot of areas around the world that have great coverage, mainly North America and the US. And there's a lot of areas in like Europe, South America, APAC that don't have really any coverage or inconsistent data. So like there's always people that are trying to fill in gaps around underrepresented populations when it comes to the consumer transaction space. And so the newer data sets are going to be like, oh, we have like a new panel that's really representative of APAC or really representative of Western Europe that adheres to GDPR rules. And like, that's probably never going to go away. Like if you understand consumer spend, there's a lot of different ways that you can monetize that. I think some are in the markets and then there's other ways as well. So like consumer spend never goes away. One of the areas I see like more like going into is like proprietary research, whether that is through like better models around the expert networks, which like are like a lot of times you use that to be able to get somebody's expert opinion on some oncology drug or on the efficacy of like a med tech device or like some new like cloud application and how like a CTO might be using it. That's one of the few areas where you can kind of get proprietary data. And I don't think there's nothing new. Like I'm also not like spend all my time on this, but like that's stuff that you can't necessarily just buy. So anything that you can develop with proprietary research and primary research is like always going to be like a big opportunity. Like there's always like different types of web scraping, like web traffic data was really big for a while. Like there are these third-party providers that would have there's like a like Avant free software provider when you buy like a Windows machine from Best Buy or anywhere else in the real world, it would have a free software antivirus system on it, and then it would anonymize those transactions, like all of your HTTP requests, consolidate it all together and get like some massive panel of the global population using free Windows antivirus software, but seeing all of their web traffic data. A bunch of stuff like came out around that, like, and there's big regulatory pushback. And so like, that's now like a big problem is like, how do you use a lot of these data sets in the context of like regulatory regimes that are going to be in different jurisdictions? Not always like a really easy answer to that. So like that's another example. There's always like, there's a lot of opportunity just to do really good portfolio analytics, really good fundamental data analysts. Like I just interviewed a guy, I don't know if you've heard of Dalupa. They have like hands down the most accurate historical fundamental data. And then they like kind of sell that as a product. Like, he was telling me some crazy stuff that they do for their customers. Like there'll be like a semis company. It was a really small cap name that made proprietary like DRAM. I think they were DRAM chips in different nanometers. And the only way that they disclosed their total sales were in a PDF with a donut chart written in Cantonese, where the numbers were kind of hard coded. So the only way that you could get what their actual sales were for different nanometer sized DRAM semis was by parsing out this donut PDF chart and then like creating a taxonomy that rolls up the way the company recognizes revenue. So like there's still kind of like a lot of data or like a lot of alpha that exists in the fundamental space when you look at like kind of global coverage. So it's not like there's not still juice to be squeezed out of data that is currently being reported to regulators as part of like a
what is the time
disclosures.
period though that some of this data or this alpha exists for, right? Like no one on this call is competing with like a high frequency trader, right? There's the long-term allocators. Like what is the range or time frame that like some of these trades exist in some of this alternative data set world, in your opinion?
I mean, it's still like days, weeks. I mean, there's still like a role for a relative valuation, fundamental portfolio, sector specific manager that is just doing a grind within their own domain. And like some of the nuanced data might only be relevant within a broader mosaic, and getting this data to be able to help understand that mosaic is opportunity for alpha that has a time horizon that could be days, weeks, months. And so in the context of a fundamental investor, there's still alpha there. And in that world, it's not necessarily something that's being eaten away by a higher frequency, lower time horizon investment strategy. Still there, hard to find.
Hey, Michael,
Go ahead, David, sorry.
are you seeing anybody, are you seeing the opposite side of that where, I guess the consumers, like people, not the users of the data, but the creators of the data are able to monetize that or sell it at all? Or do you see anything on that side, or is it all about just acquiring data from data providers?
Like there are like, for example, like the primary research is one where it's an example of allowing a user to monetize their data. So if you're like, and you got a message from a LinkedIn kind of recruiter that's like, hey, this person wants to ask you a question, they'll pay you $500 to be able to answer it. Like that is, in my opinion, an example of paying a consumer for their data. Now, it's not data that they're already producing, but it's data that they're going to produce throughout the course of that interaction. And like the benefit of that is you can get very detailed, granular data about a variety of different topics. But keep in mind, they're still only paying you, let's say, like, I mean, somebody really good, maybe $1,000 an hour. And that is for like somebody with deep domain expertise to be able to tell us everything you know about a specific topic. And there's not really much value after that one conversation. So the actual like monetizable data footprint of most consumers are orders of magnitude smaller than that. So we're like, I have heard of firms that like will try to allow users to opt in. You'll see it a lot of times in email panels where somebody could like, I forget like the name of them, but like you allow some third party tool to be able to scrape your emails, and then like they could be then aggregated and sold off, and you say okay with that, and you might get like a couple dollars a month for that. That exists, although you get so much bias associated with that data from the type of demographic that would sign up for that it can be really difficult to draw signals from. So like there are some examples, and I don't really see any really successful ones outside of primary research.
Got it. Cool. Thanks.
Yeah. But there's been like examples in the blockchain space of trying to have people own their data. Like Ocean was like a good protocol where they were trying to allow users the concept of owning their data, and it could be then transferable via an NFT. So that somebody could purchase that kind of on aggregate and then be able to get the rights to their data, or just have the rights of data necessarily generated from a consumer, but like any data provider and then transfer that as a on-chain digital asset that'll allow anybody that holds that digital asset to then decrypt and consume it. And the second they lose that digital asset, they no longer are able to access it. But I've honestly never really fallen, I like that idea conceptually. I think in practice, it's much easier to dump data into an S3 bucket. You charge me monthly and like a Square credit card payment. And if you don't pay me, I turn off your access. Yeah, there's some digital asset examples.
Why, Scott, if you want to go?
Yeah, no, can you guys hear me clearly? Oh, stop. So, these days I've been thinking a lot about AI like everybody, right? And in my world, I'm also thinking about blockchain. And I'm thinking they're going to converge, on a lot of different levels. What's your view on AI converging with blockchain?
Well, so for me, there's some things that I get excited about that are a little bit more kind of out there when it comes to AI and blockchain. One is the example of the DAO. So the original DAO, a decentralized autonomous organization, originally came out in the early days of Ethereum, and there was the DAO, not the concept of a DAO, but the DAO. And something like 30% of all assets on the Ethereum blockchain were transferred to the DAO. There was then a hack, and Ethereum lost a lot of people lost a bunch of money. They then decided to fork the chain in order to roll back to prior to when the DAO hack happened. But the concept of a decentralized autonomous organization goes back to the Vitalik white paper, early adoption, and the idea of being able to put a AI agent behind the decision-making process of a DAO and transact on chain without having a human being necessarily in the loop, I think could be very fascinating. Because it could then potentially become, to an extent, censorship resistant. So an example would be I'm on an NFT DAO right now, and me and a bunch of friends pooled a bunch of ETH together. We put it into a multi-sig framework called Kali, and then we have a Telegram group where every month we look to deploy maybe $10,000-$20,000 into a new NFT. We're not diehard NFT people, but it's fun. And we then have to vote on chain. Somebody will propose something on Telegram. Right now we're thinking about buying another crypto punk. And it's going to be around, let's say, $80,000. Everyone kind of votes on chain. And then once we get our minimum threshold of participation and approval, we then go and do the swap. And we transfer the ETH from our multi-sig into the, for example, we might use pseudo swap, and then we'll get the crypto punk in our multi-sig wallet. And that's human beings actually making that decision to transact. It's not too big of a jump of having a piece of software that is running a chat GPT model that is looking at the proposed transaction that a human being might make to, let's say we buy a crypto punk. And then based off of a series of metrics, that AI will just make yes or no decision. Do we want to buy or do we don't want to buy? And then it could go, if it has you just connected to some Python code that could side the transaction, submit it to the network. And then it's not really a human being making that decision. It's kind of the AI doing that execution for you. And then it could be possible that you could have another AI come up with different investment ideas. It doesn't have to be good, but maybe some of the ideas are good. So it might propose to the DAO, let's buy a Bored Ape. And then another DAO that has these heuristics on what is the price, what is the historical trends, pull that data into the context of the model, and then make a decision, yes or no. And then maybe you have another AI agent that is a compliance officer, and you say hey, make sure that it's not go and look up, it's not on a blacklist, make sure that the owners are doxxed. And make sure that it doesn't go beyond a certain threshold of our portfolio allocation into PFPs, picture types of NFTs. Maybe you want some NFTs associated to art, some associated to your profile pictures. And you put that as a threshold on the portfolio management constraints, almost like a risk limit. You can never have more than 50% of your AUM in a PFP. So now like that transaction can't be signed by the agent DAO until the agent, the trading AI can't say, yes, I want to buy it until the compliance AI approves it. And you start kind of getting these like somewhat complex organizations being managed on an AI, but then executed autonomously on chain. So like when I get kind of excited about the usage of AI in on-chain assets, like I kind of jump to a bit of an extreme of thinking about how a DAO could actually be managed by an AI that has the ability to sign keys based off of certain prompts and training models. And let it run wild, see how it goes. Honestly, we're down about 60% in our NFT DAO, so it really isn't going to do that much worse than us.
Hey, Michael, why do you actually need the DAO part of that thing? You could do it. I mean, aren't you able to do this without a DAO? With just
you could, but how is Fidelity? Like, if I want an AI to represent a account on a Fidelity or like any sort of brokerage service, you need oftentimes a human being or a legal entity associated with that. Like now our DAO does have an LLC, a Delaware LLC behind it. But the cool thing about a permissionless blockchain network is that there's no one to say that you can't do it. There's no one to say like you can't have an AI be the actual entity that is being represented when you go to do a swap of a digital asset. Now you could do all of that and have a human being ultimately execute it. And it would be like from the investment perspective, kind of like the same way, but then you kind of throw the human being in the middle there, which isn't necessarily as fun, but from a practical perspective, it totally makes sense. Now, where it might actually be beneficial to have the AI do the execution is that you're able to remove potential liability from a human being from the repercussions of doing a certain transaction decision, like a trading decision. So for example, if I don't know what would happen, but like, let's say,
who would you sue? I feel like our society thrives on someone being able to be sued. Like it's an entity or an individual. Like what happens in that case?
Totally, exactly. But the problem would happen is that a lot of the AI models right now all run on centralized frameworks. So like ultimately, if in this example, let's say I'm Michael Watson, I'm signing up for a Microsoft Azure account and using their GPT-4 model on my behalf. And so it's running on a centralized service. And like you'll hear a lot of people talking about more regulation associated with the cloud providers of large GPU clusters. And as long as there is kind of that dependency on like a human or like some sort of compliance element of getting access to a large language model, that you're going to have that human being in the loop for at least signing up for like the API keys and paying for like the cloud bill. But I think what would be the next level of that is, can you run a language model on decentralized infrastructure? So that in this, like, and that's a relatively hard problem to solve because like the non-deterministic nature of a large language model, that you could have two different nodes execute a given prompt and come up with a separate result. And then who's going to validate which one of those results didn't lie? Because that's one of the things you need to do in these decentralized networks. Like somebody does a transaction, we say like what the result is, and then we all verify it and we say, yep, that's right, they didn't lie. We're going to add that to the next block.
Mike, let's talk about today's use cases, right? So one of the things that like I've come to the conclusion on just from like listening to experts in this space is that there are hedge funds that their language models are much different than what we're seeing available to the public today. And while theirs may be better suited to deal with noise and prices, the large language models we see today out of the box are not really good at dealing with like historical noise on prices. It's very much a very basic algebra formula to get to the next likely word in the equation. So what are the use cases today? Is it really just like going through 10Ks, 10Qs? How else are you using it when you're thinking about trying to source unique alpha, unique data sets, and things of that nature?
Totally. So like some of our example initial client engagements that we'll do with Hedgineer will be with a fund that potentially already has a lot of like their data well structured in-house via various APIs. So they'll have maybe a risk API that'll say like, all right, what is our year-to-date idiosyncratic returns? What's our year-to-date sizing return or P&L? What's our year-to-date hitting P&L? What's our year-to-date trading P&L? And then have another really good API for like, what are our analyst estimates? What are our what is like the sell side estimates? And then just put those into a off the shelf language model and then do in context learning so that when a PM maybe goes to an app, says like, hey, like, what are my biggest, like, when's the next earning date for my biggest positions? To a chatbot, you then have a earnings date API and you have a portfolio analytics API. The AI makes a couple different calls from when you make that request. The first one is going to say like, okay, who's the user? They're asking about their portfolio. What is the API that needs to be called out to tell me their largest positions? And then once you get the results of that, you send it back into the language model. So you have another process call out to some internal API, like some Python wrapper. It calls out to, all right, there's PM Cynthia Murphy. What's her coverage? What's her largest positions? All right, she's holding a big long on Apple, a huge short on Netflix. Okay, those are the biggest positions. Now let's go to the earnings date API. When is Apple's earnings date? When's Netflix earnings date? And then now let's go back to language model, summarize to the user based on their question, what is the next earnings date for their largest positions, which is Apple, Netflix, and it's July 3rd and June 14th. Then the user then sees like, oh, your largest positions, Apple, Netflix, long $20, short $30, and there's an earnings date coming up on July 4th and June 5th. And those are from the user, that's all done kind of seamlessly, and it seems like magic, but really they're just like, there's two elements here. One is you're calling out to this non-deterministic API that is the language model, then that's leveraging very explicit APIs that are deterministic, a PMS interface, earnings date interface, that those are very black and white, they're right or wrong. And then blending those two together so that the user is able to get like a result that seems like magic. And they can start introspecting their internal data that they already have. And I think that's where like the biggest use cases that I've seen is just because right now it's all like exposing complex interfaces, complex UIs, or within like your domain expert, your research analyst that really knows how to pull all that data together and trying to move them out of the way.
So Michael, a couple of things there. The brilliance that you're sharing is great, and I love it. I'm going to just tell you, your audience may not be aligned with the knowledge that you're sharing. So definitely, I mean, PMS means something way different to me than perhaps you. But with that, Eric Connolly has a question, and he's always our genius in the room too.
Yeah, I just want to ask, how far along has the SEC inquiry into the Yodlee or whatever they're calling themselves data and the cell phone location provider data gotten? I know those have gotten kind of weird from a compliance perspective. Thanks.
So one, I don't want to talk about any specific data sets because I honestly, I'm not really sure. I've been a little bit removed from that for several months. But there's always been regulatory screening. I'm also not an expert on the legal and compliance side. So I don't know if I'm actually the best person to answer that, but there's definitely a lot of regulatory scrutiny on that. And I think that's like, it's healthy. It's like, it's good for regulators to be aware of like how, I don't think it's just SEC. There's also FTC, right? There's consumer protection laws that a lot of times go into that as well. That isn't just about securities law, like consumer protection, consumer privacy, like I think is just as important, if not more, in some of those cases. And it's not necessarily about like having the data get to investors in public markets. I think the stuff that really broke a lot of the concerns on like the web traffic data was NGOs and like the non-government agencies, foreign governments using that data to be able to track US citizens. And that's actually what I think blew up a lot of the anonymized web traffic data, and not as much on the public equity investor market. And all of that's like there's good like New York Times exposés and stuff on that.
So what happens when you're live at a massive hedge fund and one of your data sets turns off? Like, for example, live example, Twitter, right? Now you're restricted on how much you can export or how many tweets you can see on a daily basis, right? So if you had a system built on that, I imagine 100 engineers sitting around, someone just press the stop button and like the whole system, the whole train stops. But like, what is the plan of action in that? Like, just your thought process on how do you handle those kind of scenarios?
I mean, if it is like existential like that, there's always going to be break glass scenarios where oftentimes there's going to be a trader that is going to be overseeing, if it even is systematic, that like something fundamentally is broke in the pipeline, and will like essentially just break glass, stop all trades. Hopefully you're not too directional at that point, but then you oftentimes want to be able to assess and then start winding down until you have a better understanding of what the breakage is in the pipeline. And then it might turn into like an escalation process. So most of these, like most firms will have a relatively sophisticated incident management response process. So like there'll likely be like a Slack group or some alerting software that you'll then trigger, that the trader will trigger. It might get automatically triggered when that feed goes down. And then a bunch of people start getting on calls, kind of assess what the issue is, and then figure out what the go path forward is. But it's usually going to be the trader right away that if something breaks, they stop, break glass. You might already have a system that's going to automatically stop that. And then it goes to an incident management, incident response process.
So I have it's a dumb question, but I'm thinking, you know, as we see if in this pursuit of new opportunities for alpha, that where data is super important, to go back to your initial point about the crazy PDF where you have to, you know, deconstruct in order to actually access the data, is the biggest impediment today, whether it's hedge fund world, the ETF world, just active managers in general, is it acquisition cost of data sets, or is it the technology to decipher the data sets? What is the biggest obstacle to actually get to the alpha opportunities?
I would say actually having good ideas. Like I think technology can be commoditized and data can be bought, but actually having a really good sound investment idea for how you want to use data for a trading decision or an investment process, even before you have it, that is built off of well understood market dynamics, whether you're using data for a macro structure or a micro structure. That is, I think, the hardest part. And then it's a resourcing problem. So it's either going to be time and money, and time and money can oftentimes be bought, but it's really tough to buy good investment ideas for how to actually use data to make money.
Fair enough. Fair enough.
I think unless we have more questions on the data side, now is a good time to transition over to the Bitcoin and crypto exchange and potential crypto ETF portion of this conversation. So I'm going to give the floor to Dave Abner and ask you, what day next year is this fund launching and who's launching it? Why don't we start there? But in all seriousness, if you have any updates or thoughts on, you know, we know, like, I think BlackRock's now refiled twice, and now people are saying ARK might have jumped ahead of them using the language that BlackRock crafted or their agreement with Coinbase to then get them ahead of the curve. Are they going to give them one of them like a 1 second lead? We've seen more than ever, like a 1 day lead in the ETF space can be night and day. You can get $300-400 million, and all of a sudden you're the second day product, and you are now second to market with the 24-hour delay. It's that important. There's fortunes to be made and lost based on like this decision. Not that Larry Fink or Kathy Woods are without much, but Abner, floor is yours. What are your thoughts?
Well, you started with what day next year are these funds going to be listing? So let's start with a view first. There's definitely, so when people have been talking about probabilities recently, my probability is at pretty much 100%, if not slightly less than that, that Bitcoin spot ETFs get approved by the SEC and start trading. The timing of that in the US, so the timing of that is, and we're no longer in this sort of 8-year process that we've been in. I'll clarify, right? What I can't say that, you know, the 240-day countdown will end by December this year, and that will definitely be the day of approval. We don't have that much clarity yet, but I can say with certainty that we are on the approval path, and that in the next sort of 9 to 18, 24 months, there will probably be at least one, if not multiple funds trading in the US. Okay, it's not going to be, it's not, I'd be surprised if it happens in the next 6 months, but, you know, I wouldn't be so surprised if we see an approval quickly and then maybe some things that need to be done, which delay the actual listing a little bit.
And now I'm going to use one of your tweets as breaking news, but you did have a post today that you were commenting that this should have very little effect on the price because everyone, for the most part, at least in the institutional world, who would in theory be buying this newly filed Bitcoin spot ETF is likely already on Coinbase or has their own cold storage in the crypto world and has their assets, and it would just be potentially a transfer over to the ETF wrapper for simplicity purposes.
Yeah.
Can you comment on that a little further?
Yeah, look, there's a little bit of nuance there. I do think so we're in the industry, we're in the ETF industry, we're in, you know, financial services, so we're paying attention to what's going on in Bitcoin in particular and ETFs in general and the markets. So we are focused and think things are going to happen more quickly than they generally do. Investors, the general public, they actually go to work on a daily basis. They're not necessarily watching the markets or reading the financial news, and then they make investment decisions, you know, on the weekends or when they get home and get a chance to catch up, right? So I do think there is a delay where all of the people that may want to purchase a Bitcoin ETF for a variety of reasons have not actually positioned ahead of that, right? So I wouldn't be so surprised actually if we saw, you know, if you think of the standard trope, right? Buy on the rumors, sell on the news. I wouldn't be surprised if we see in a scenario where Bitcoin sentiment causes a Bitcoin rally into the launch of the ETF, that I'll go so far as to say that brings us back towards the sort of 60,000 top. But I probably personally would be a seller of my Bitcoin if we were back at that level at that time frame when that was happening. Okay, so that's sort of the way I think about it in terms of pricing, right? And pressure. I think there are some, you know, look, the advisor community has had an opportunity to use BITO, the futures-based Bitcoin ETF. So it's not completely new to them. When people say, oh, advisors are waiting for a spot ETF, you know, we know the advisor community, they don't always sort of differentiate between using a spot, you know, between using something like a physical Bitcoin ETF and a futures-based ETF. There are some that would hold back on that, but you can see from their use of GBTC that the sort of nuance of the structure of the product isn't always as important as you might think, right? So there's a lot of advisors that have already tried to achieve their Bitcoin exposure through GBTC or through BITO. So I don't think there's this sort of massive sort of group like waiting for the gun. There are some, right? And I do think this will be bullish for a point. But my own personal view is I don't think this is like, you know, Bitcoin 500,000 or anything like that.
So just to have a little fun here, over under, does it take place before the halving or after the halving? Because you know what, there's a little level of irony here that nobody's talking about the halving as an important date for the launch. But how crazy would it be if it took place the same date as the halving?
Why is it such an important date for the launch? Like, I think these two things, I think everybody is bringing everything together, right? Like the grayscale lawsuit and the BlackRock filing, and now you're talking about the Bitcoin halving as all of these being massively interrelated events. And I don't necessarily think of that as true. I mean, look, the halving is a corporate action, basically in traditional financial terms, right? We've had millions of corporate actions in the world. We know how to do that, right? If you're going to get a Bitcoin spot ETF launch, most likely, if I were an issuer, I weren't launching on halving date. I'd probably delay, or I'd probably try and get it out the day before, the day after. From a technical operational standpoint, just so the operations team doesn't mess up anything like a split or something like that, right? So I don't think of the halving, as anything so important in that sense. I also don't think so. A lot of people have asked, like, why do we think like BlackRock is doing this? Why are they doing it now? Why did they file now? Why did they throw their hat in the ring? And there's some interesting things there. I have a view that it's not often that you have a large asset class that you have a chance to become the incumbent in. So I think that's what's driving a little bit of the BlackRock motivation here. And I think their view, and I have no idea what their actual view is, I haven't spoken to them, but I think there is a potential view that says, well, GBTC was a likely incumbent. In my view, that fund never converts to an ETF. But you then have a large asset class with no incumbent. And in BlackRock's view, like, if they can get out, whether they're first by a few days or not, I don't think days matter with BlackRock. They could very well be the leader and gather a tremendous amount of the assets that are there, right? I think that's more important in my view. That you just don't see that too often, right, with a new asset class in the industry. So I think that's what's driving this a bit. Any questions on that? I said some inflammatory things.
Brittany, you're up.
My question is around, so obviously Bitcoin is sort of in its own class in the crypto world. Can agree or disagree with me on that. But assuming you're right and Bitcoin spot gets approved in the ETF wrapper, how long do you think before other coins will follow? And is this something that you see turning into sort of a diverse way to get exposure to the crypto as an asset class without having to put all your eggs in one basket, so to speak?
So it's a great question, right? And you can be sure that issuers that are thinking about Bitcoin ETFs are already thinking about Ethereum, and like there are issuers like 21 Shares that has, like, I don't know, 20 different tokens listed in Europe, and there's Bitwise here with there's lots of different issuers with lots of different ideas. So they are going to want to push those limits. Now, what's interesting is you've got Bitcoin as a commodity. You've sort of thought of as a commodity by the SEC. You've got all of these tokens, which there's more and more talk about them being actual securities. You've got this process where people are talking about surveillance of the crypto exchanges, and it's not, I can pretty much assure you, it's not just going to be Coinbase, right? Like, it would be, there will be probably a sort of push by all the crypto exchanges to agree to this at some point, right? Coinbase may be the biggest and the first, but if I were a crypto exchange, I would, and I didn't want to agree to this 3 or 4 years ago, but if Coinbase is agreeing to this now, I probably have to agree to this to get on board. I think this is you are seeing this sort of further coming together of traditional securities and the token market. And so, like, I don't know exactly how it's going to play out, Brittany, but I do think there will be that will come together more, right? So if Ethereum is deemed a security, well, then it will be really easy to issue clearly. Then it will be really easy to figure out a way towards an Ethereum ETF, right? A spot Ethereum ETF. And that will be the same for, so the way I would do it is I would think about the token market like the small cap market to a degree, just different technology. And you would think these two will come together. I think we're on a path where, maybe it's 10 years ago. Michael, you probably have more of a sense of timing, but like traditional securities will all look like tokens, and all of us in the room won't be able to tell the difference that our securities have been converted to tokens, but that's how we trade them now, right? Like, and that will lead to, the streamlining of this business further, right? Like that to me is like, if you heard Larry Fink talking about tokenization yesterday or 2 days ago, like that's his big play here, right? Like Bitcoin ETF is capturing the news, but tokenization is going to take a $2 trillion issuer and offer him 5 different ways to streamline his activities and maintain his margins, right? And that's, I think, what this is all about over time. And I don't know the exact timing of that, but there's a lot of people that are pushing to build that sooner rather than later.
One last quick question, then Cynthia.
I was actually going to kind of add on to Brittany's question, is that like, if you look at the SEC filing against Coinbase right now, they are being accused of having an exchange for securities, and they call out explicitly what those securities are. But just as interesting, they explicitly don't call out other securities, which are being implied to be a non-security commodity-like asset. Those being Bitcoin, Ethereum, Litecoin, Bitcoin Cash. And so if you look at those returns since that filing, all four, especially in the lower volume Litecoin and Bitcoin Cash, those have absolutely ripped. The theory being that those are going to be really good proposals for the follow-on after the ETF. And so you might get a lot of flows going into a Litecoin or a Bitcoin Cash, because those seem to have been deemed at least a non-security asset, because they're not being called out in the Coinbase SEC, the Coinbase SEC charges. But I think what's also interesting on that is like this delineation between what is a security and what is not, and that will I'm assuming that's likely going to be the delineation of what's going to be the first movers going into these ETF wrappers. And I don't know if anyone has a chance, like the McHenry proposal for crypto regulatory frameworks in the US actually have a good model for when a instrument would be deemed a digital asset security versus a digital asset commodity. And if that bill ever does get momentum, that'll essentially be a template that a lot of your projects, for example, like two of the biggest ones that have actually been really hurt from this, Matic and Solana, can follow, so that they can start issuing more of their assets through their foundation, so that they adhere to the McHenry bill, so that those would then be able to follow on this ETF wrapper. But there needs to be a better framework, because right now, because they're called out in the Coinbase SEC filing, they're essentially in the doghouse. And so there's not a clear framework for how they're going to get out of that doghouse into an ETF like wrapper. So you'll see like Matic, look at the returns post SEC filing against Coinbase, and they've just been actually atrocious, while BTC is up in that same time frame. Litecoin is up over 100%, Bitcoin Cash, well over 100%. ETH is actually up since then. Sol has been popping for like a little bit over the last couple of days, but Matic has gotten absolutely crushed by being on that list. So figuring out a framework to get off that list, I think, is going to allow some of these token, digital asset securities to potentially get a pop with some of like the liquidity you might get from an ETF wrapper.
So if you had to describe your crypto trading strategy, and we're talking macro, fundamental, quantitative, and hold, where do you realm, and how many times in your momentum side have you woken up in the middle like, oh my gosh, I got to go check my computer?
I've never regretted buying more. I mean, part of that's kind of like a timeline, but I've always regretted. I've regretted selling. Some of I've been happy to sell and felt like it was able to do relatively well in it. But I'm not like holding and not trying to think about it. I've been in. I mean, I have the benefit of saying I was in 2013. So like, of course, I'm going to say just hold and wait these things out. But holding and trying not to think about it and actually believing in the space. I think like one of the things that I have is like I happen to align with some of the ideologies of the decentralized finance, decentralized infrastructure. So for me, it's like just.
I think you have to be 3 years removed from Citadel to say that. I'm sorry, man. I don't think.
Probably. Well, I'm not quite at 2. So like I still have some non-compete. So I'm not fully there. But
you have all your coins on a little wallet in your pocket right now?
Yeah. So most of it I manage with my ledger and other like self-custody mechanisms. One of the things I'm actually like, I like these ETF wrappers for a lot of investors. Now, like I know Coinbase is, I believe Brian Armstrong and the team there are trying to do the right thing. But there's a lot of things that you can make a mistake on when somebody could trick you into transferring assets to a cold storage wallet. And like my grandma's been scammed on Bitcoin. I told my grandma, they never touch Bitcoin. Like it has no, I think, positive value for you as like an owner of Bitcoin, even if you're doing it through an exchange. Now, that's because I don't think there's a lot of really good safeguards. That these exchanges will try to whitelist transfers of digital assets to an on-chain wallet, but there's only so much they can protect you from yourself. The ETF wrapper, I think, does give you protections that you're not going to get via a Coinbase. Like, for example, my grandma can't transfer her ETF positions to a third party by like any reasonable mechanism. And I like that protection. I like the protection of knowing like if my friends just want to invest in it and they don't have the sophistication of being able to manage your own private keys, which I think is an important problem to like know how you're solving it and think about it. The ETF wrapper kind of protects you from that. And that there's no way to transfer those assets outside of like these centralized exchanges. So I'm actually, I think that there is a lot of value being added here with the development of the ETF wrapper and the ecosystem. Some people think it's a backward step from decentralized technology and decentralized finance, but I actually see it as like an incredible step forward and actually to an extent an embrace of decentralization. Like right now, and Dave and I kind of had a back and forth on this. We were talking about EDX. But like right now, if you look at a Coinbase, they're a broker, they're a clearinghouse, they're an exchange, they are a custodian, all within one single entity. And that can allow them to do things really quickly, settle internally, clear internally. You just transfer it to one location and you can certainly do all these interesting separate trades, but it also allows them to do some things that are maybe too powerful and do some things that are potentially not in the customer's best interest. For example, like trade execution quality. Like, is anybody like call on Coinbase if you don't have their pro account for the quality of trade execution you get when you're trying to actually make a purchase? It's absolutely atrocious. You would never get away with that in equity markets. So
that's actually part of why they should be, we're moving towards surveillance, right? Like, because these are exchanges that are not treated like exchanges, but they are, right? And they should be, the US has really strict rules around our exchanges for a reason, customer protection. And, we should be thinking about Coinbase offering those same protections, right? I think that's been the big holdup in this whole thing. And that's where we're moving towards, right? Like EDX is potentially a solution there, but I think that's a good thing for investors as well, right?
Abner, you were early talking about how this might actually be like the death of Coinbase's revenue, right? This is them kind of eating their own lunch, because this is going to put so much pressure on them to really improve their pricing and trading execution, or else it's just that much better for the end investor to actually just hold the ETF, unless you can actually know what you're doing on this execution side, which most people on Coinbase probably don't even put any thought into that at all whatsoever, right? So it could actually be like the mutual fund world eating revenue to transfer the ETF to have more of a market share. For either of you that want to jump in on that one.
Totally. I mean, like, I also like the idea of being able to hold. Yes, I agree with you. Kind of wholeheartedly on both of that. I also like the idea of when I have cash, I'm getting like a couple, like, I don't know, 20 basis points below treasuries, right? So like if I want to sell out of my Bitcoin position, I want to be able to get my 500 basis point, or I want to be able to get my yield and holding it in a brokerage account. Whereas like if I sell out of I'm not getting yield in my cash holdings in a brokerage account on exchange. With the ETF wrapper, I get that if I just want to hold and get out of the position, which is nice. So I'm actually quite bullish on it. I think there's the other element, and Dave, we talked about it previously, and I'd be kind of curious what your thoughts on it is. I don't know if some people here saw like the EDX. It's like the Citadel exchange. They are completely separating the custodian from the exchange, which will then get cleared outside of the exchange. So like if I were to want to, it's only for institute, like you go through a brokerage, you can't get an account on EDX. But let's say I go through like Fidelity custody, or you go through Fidelity, I purchase Bitcoin spot on EDX. It then gets routed through the Fidelity account on EDX. They then monitor all the transactions, and then they basically send that over to a third party yet to be named that'll do the clearing. But what's not happening is that there's an internal like kind of omnibus account that exists on what's in Coinbase, where like it's all in a database. We have a bunch of Bitcoin in a couple like cold storage wallets, and all these transactions are actually happening on a database internally. In the EDX world, they're going to have to settle. Like at the end of the day, we're going to have to figure out like, all right, how many Bitcoin did I hold and how much cash do I have? And there has to be an on-chain transaction of transferring those Bitcoin between two parties. And that is, in my perspective, a huge step forward in the usage of decentralized technology, because now we're actually doing on-chain settlement. It's not happening on every transaction, but it's rolling up maybe on a T+2 period or a T+1 period. Every day, all the transactions that have happened on an exchange like EDX get rolled up and settled on chain. And so you can see where all of these transactions are actually occurring, more transparency into the system. So I actually think it's a pretty cool development.
Yeah, look, it's funny, I do go back and forth on this, right? Like I do like the idea of trading, custody, clearing, all being together, right? Like the streamlining of all of these different pieces. And I think the way you perceived it, I'm by no means putting words in your mouth, but the checks and balances of the current system sort of make sense, or at least have provided a lot of protections for investors. I think the way you describe it, we're going to move that this sort of middle level where you're right, we should be clearing all trades on chain, and then it's clear, and then you can sort of remove the clearinghouse piece of it, right? And you can see it. That makes a lot of sense to me in terms of streamlining the systems further, right? Like I think I do think all of this is going to come together as a systematic solution to it. Like what I don't think was like, I mean, if I look back now and I see, Coinbase or any of the exchanges saying we are completely different than, and what has happened before makes no sense, and we're just going to be completely different, which is why we don't fit into the current rule books. That to me doesn't work, right? It's iterative, and the technology is better, and we're trying to get there. in a way that we can sort of solve things without just wholesale breaking down everything that existed and rebuilding it in this new structure. That's what I think, we're sort of fixing that now.
Mhm.
I mean, maybe there was an easier way to get there, or maybe not. Maybe this is the only way that you could have gotten there.
Yeah, I think sorry.
No, I was just gonna, go ahead, finish your thought, Michael.
Oh, I mean, I agree with everything you said. And I think this was probably the only way to get there. If Coinbase would have started with this more decentralized approach from the get-go, I think they would have taken them forever to get product market fit, make easy to use experiences for people to trade Bitcoin. Like, I mean, I personally Coinbase to an extent kind of changed my life because they were the first way that I was able to get access to crypto without having to really do too much research other than saying, yeah, I love the idea. And so for a lot of people, they allowed them to make life-changing investment decisions when there was no other product out there. So whether or not you think it and I could say they did some things that weren't ideal, they bastardized a beautiful system, but they also gave a lot of people access to something that there was no other way to do it. And I think for that, what their contributions are for any regulatory concern were incredible. I think they did great work.
Yeah, I agree.
Sorry, Cynthia.
So, no, I was gonna say, unfortunately, we have to wrap, but I just wanted one quick question to you, Dave, about BlackRock to go back and finish with a thought about him. Doesn't it feel brand inappropriate to access Bitcoin through BlackRock? Doesn't it feel like if you're a Bitcoin investor, you're out there saying support small businesses, and then you go in and do all your shopping at Walmart? I mean, there's something about it that just doesn't seem like a good fit for the type of investor that would pursue Bitcoin, unless as an ETF investor, it's about an asset class more so than the actual decentralization story. So I'm just wondering, from your perspective, do you think BlackRock, outside of the long-term tokenization story, all that, just as an ETF, spot Bitcoin ETF, do you think they actually have legs here?
Yeah, look, I think, if you go back in time, right, the iShares products were originally the Web's products, right? And they enabled US investors to access country stocks like Malaysia when they could never have accessed Malaysia, for example, in IWM or a variety of different funds, right? To me, the ETF wrapper has always been about providing access to investments for investors, right? And BlackRock is obviously one of the largest firms. It's natural to me in that sense. There are institutions that build their entire portfolio around BlackRock ETFs, right? And not having access to that is partially what and them saying, well, we want to have some Bitcoin in our portfolio, and BlackRock saying, well, that one, we don't want that one. That would make no sense, right? So as an access product, and like you said, a wrapper that provides some more security for investors, easy to use, we're going to figure out all sorts of ways to sort of stake within the wrapper and things like that over time, not this year, but uses within the structure itself will be beneficial to investors over time, right? So it makes perfect sense in my mind that BlackRock would be thinking about it from this standpoint and would be bringing product to market.
Mm-hmm.
Guys, I want to thank you all for joining us on today's call, Michael, Dave, and all of you guys listening in today. Mike, if you want to direct people to your website, it's hedgineer.io. But if there's anything else you want to comment on that, and your videos are on YouTube, etc., anything else you want to promote on that side, the floor is yours.
No, that's it. Also check us out on Apple Podcasts, Spotify. Follow us on Hedgineering on Twitter. And I love the chat. Feel free to reach out to anyone that's curious about it. We also have a Slack channel where I'm always on, and some of the other people on the team. It's hedgineer.io/Slack. Anyone's welcome to join.
Dave, anything you want to promote?
Look, I'm easy to find. dabnercapital.com on LinkedIn. It's easy to get me. Happy to talk more.
He's the leader in Bitcoin subtweets in the last week. So he rebuts everyone's comments. So just keep looking down, and he's usually making a really good point somewhere. So thank you all for a great show. Appreciate it.
Cheers, everybody. See you next week.
Everybody, bye.
Software.